My journey began in 2021 when I was still in university. I was passionate about real estate and I was dreaming of becoming a big real estate investor, which I still do. In the meantime, I attended conferences. I went seeking for knowledge. I'm meeting people, sharing my goals, until one real estate investor told me something that shifted my path. This real estate investor told me, before you become a real estate investor, you really need to understand and know how money really works. And that really shifted my path because I felt like jumping from being who I am to being a real estate investor, I wanted to know something. She suggested to me that I could maybe become a financial advisor. So I got licensed, started working for this big life insurance company. By November 2021, I was starting to work for this life insurance company. The reality check of what I was living is the following. I thought I was going to learn how money works, but what actually happened and what I actually learned was where people save money, not how money works or how money flows. Okay, I knew all the products that are on their shelves. I knew about RRSPs, I knew about RESPs, TFSAs, life insurance products, investments products, but something inside of me kept saying, you still don't know how money works, because if you knew, you'll really be maybe a bit ahead in your life. So I still kept the thirst of knowing how money works. Yeah, even though I had the knowledge of the products, I was making money. I got married. I paid my wedding in cash. So I had no debt on my wedding. I was living well, but I knew deep inside of me something was missing. So I did that for about 2 years, close to 2 years. And in January 2023, a successful real estate investor that I had met on Instagram reached out. And when we were discussing, he brought up something that was on his heart. He wanted to learn about a strategy called IFA. IFA stands for Immediate Financing Arrangement, because he was telling me that his private bank, where he was banking, had introduced him to this insurance strategy tied to collateral loans. Okay, but he didn't trust the bank's motives. He was like, I'm with you for years now, but it's now that you are bringing up this strategy? Why is the bank suddenly talking to me about insurance? So he really wanted to know for someone who was not biased and someone who is actually doing it. So because I was making content at the time, he came to me. So I explained what I knew about the strategy, but I felt like there was a lot to uncover. I went and looked at the life insurance companies and even went online. So when I went online and typed that strategy, the first thing that came in my search was infinite banking concept. Again, early 2023. It was my first time hearing those words, infinite banking, but I got hooked. And when I went deep into research, I was able to see that it was created by a man called Nelson Nash. When I tried looking for him, I found that he actually passed away in 2019. God rest his soul. But what I did, I bought this book called Becoming Your Own Banker. And when I started reading this book, I'm talking about not even reading past the 5th page, the 3rd page, the introduction. Something clicked. I felt like Nelson Nash is addressing what I'm living, what I've been living for the past 2 years. And this is kind of what I was looking for. It is how money actually works. Even though I didn't end up doing business with this client, this concept didn't let me go. It changed my entire perspective in one reading. For the first time, I met something that I wanted from me, not something that I wanted to later end up going to sell to someone else. No, I first of all wanted it for me. I wanted it for my family. I wanted it for myself before I even go and tell it to someone else. It was that precious. Now, I looked for a mentor who would actually teach me this concept, and I was able to find one. So from September 2023, I just went all in. I left my financial advisor job that I was doing, and I just went to study under this mentor. I devoured every Nelson Nash Institute resource. I watched every video that is online, and I repeat every video. I even watched the video that are behind the portal for practitioners like me. So that's when I finally learned that now I'm learning something. Now I'm learning something palpable. The history of money, and most importantly, how to control something called banking. Not controlling investing, banking. It is the foundation for wealth creation and preservation at the same time. There's nothing that happens without banking. We'll get to see it later. Now, I didn't just learn it for myself. I implemented it in my life. So from September 2023 to about March 2024, that's all I was doing. Going into every resource. I had no other job apart from that, just studying under a mentor and learning every resource that I could. So by March 2024, I was confident enough that this is just a way of action that I'm supposed to take. So I just didn't learn it all that time. I implemented it. Because from September 2023 to about March 2024, that's all I was doing. And by that time, I had actually decided that this is just a course of action that I would like for myself and my family to take. So I bought 2 policies, and I later ended up buying another policies about a year later from that time. And presently, I have a policy on myself, I have a policy on my wife, and I have a policy on my son. And we deposit in our banking systems, our system of policies, about $51,900 per year. And more policies are still coming in. So we learned that we can actually use these contracts, these policies, to finance everything that we need in our lives privately without losing control of those dollars. But simultaneously, because I believed so much in this message, I started teaching it to others. And since then, I've helped over 200 Canadians, including families, including business owners, including people who are retired, to design their financial dealings along these principles. And the good news is, over those 200 Canadians that I've met, personally sat with them, just like I'm sitting with you right now, 145 of them are just happy bankers today. And that number is growing every single week. So that's why I've decided to just make it my mission. My mission right now is to bring this knowledge, the knowledge of this book, the knowledge that probably you've never thought of because nobody's teaching it in English and in French, so that more Canadians can experience financial control and peace of mind overall. So if what you're about to hear resonates with you, maybe it's your time too. Listen to this with an open heart, because this can truly change your life just like it did for me. So I'm Loris Mugisha. I founded Private Reserve Financial so that I can teach Canadians that the real choice isn't between Bank A or Bank B, but the real choice is between someone else's bank or your own private banking system. Because in the beginning, most people don't know that they can have their own and control it, because your money has to live somewhere. So why not let it live in your private reserve, where you own it, where you control it, before you start now deploying that money to buy what you need and pay what you owe. It is possible, and you can start one today. So this is the essence, this is the objective of becoming your own banker, the Infinite Banking Concepts by Nelson Nash. This next part that I'm about to talk about is about him, Nelson Nash. For those who did not know him, you have the opportunity. And for those who know him, you'll know him more. On this next section, I'm going to talk about how this man, Nelson Nash, used this same concept to eliminate $2.5 million of debts in his own life. So, a little bit of history about Nelson Nash. He studied forest finance. He graduated in 1952 and later became a life insurance professional in the 60s. And among many other things he was doing that he liked, he was also a pilot. And being a forester, he spent so much of his working life around land, around timberland in fact, which drew him to like real estate because he knew how to turn land into profit. But like many investors of this time, he followed just the common formula. And that formula is the following: use leverage by borrowing the bank's money, purchase an investment property or land, or let tenants cover the interest and the mortgage payment, or flip that land or that house. All right. After you do that, you later decide if tenants are still in the house, sell the house and pull out your cash, or refinance. And after you are done with that, do it over and over and over. And there goes your real estate ventures. But for Nelson, everything worked. Everything was fine as long as the leverage he was using was working on his side, as long as the lever was on his side. Except that in 81, Nelson Nash was heavily involved in real estate, and precisely real estate investing. He had bought large plots of land in rural areas that he wanted to develop, and he got a commercial loan. And that commercial loan was at 9.5%. Prime was 8%, and the rate of the commercial loan was 1.5%. And that loan had to renew itself, was logged in for only 90 days. Just imagine 90 days. Except that something flipped a year later, 1982. The prime went from 8% to 21.5%. So add the 1.5% that he was already owing, That becomes 23%. And in 1982's money, he owed $500,000. That's 2.5 million Canadian dollars of today's money. And his annual interest alone, the amount of interest that he was supposed to pay on that loan, that commercial loan, in today's money, 338,000 Canadian dollars. So in this position, selling wasn't an option. Buyers were not just there. Nobody was willing to buy it. And the leverage that once built wealth for him now turned into a trap. All he has built was about to just vanish like this. It was not only that story, because before that story came a lot of hard periods in his life. Because during that same period, his home was cleaned, was robbed in broad daylight. Men came and stole everything. He identified these men as drug junkies looking for silver. 2 months later, his biological brother died at 52 years old of a heart attack. 5 months later, his granddaughter, his second granddaughter, was born with cancer. Thank God she later recovered. These are turns of events that are happening in his life. Just imagine the weight of grief, theft, and having a debt that is crushing you. You are 51 years old in 81, a husband, a father, a grandfather. Now you are literally staring in front of you bankruptcy. That was his reality. I know life challenges can shape us, can make us strong, but when you mix these life challenges with financial collapse, only grace can really keep you from breaking, literally. When someone goes through this period, one of the best choices you can do is to pray. Thank God Nelson Nash was a devoted Christian, and he began praying daily between 3 to 4 a.m. And his prayer was simple, as he declares in the book. Lord, please show me a way out of this financial nightmare that I have created for myself. That was his only prayer. And over those many, many months, him praying, a revelation came to him as the following. You are standing in the middle of everything it takes to get out, but you can't see it because you are looking at things like everyone else. So here was the hidden resource that later came as a revelation. While banks were charging him 23%, life insurance companies offered policy loans or offered withdrawals at 5%, rather policy loans, against cash values in policies that he already owned. Because he was accustomed to have whole life policies in his life, yet he has never used them or viewed them as sources of liquidity, he wasn't considering these policies as a source of liquidity. So he was literally stuck. So the new plan came about this way. He was going to increase his premiums as much as he could in order to build more cash values that he can borrow against and go and eliminate the banks. He calls them snakes and dragons. And the goal is to borrow against those cash values without interrupting any of the accumulation that was happening in order to pay off the high interest bank debt. Borrow at 5 to 8% and go destroy a debt that is at 23%. Once he does eliminate those debts, he will redirect those payments back into his system, not into someone else's bank. But guess what? By doing simply that, it took him 13 years in order to eliminate the debt. It was a plan. He followed the plan. It took discipline, but it was working. He added capital to his policies. He borrowed only from them. He didn't borrow a loan somewhere else and came to eliminate another loan. He paid debts down with money he accessed in his policy. While he was doing that, dividends were just compounding in his policy, and cash values was just growing on a very uninterrupted basis. And after 13 years, I repeat, the banks were gone. He called them snakes and dragons, as I said. From 1995, his family, up to this day, they've never used a bank again for anything other than the convenience of debit. They only use them for transactions, not for credits, not for loans, not even for the purpose of saving money. Banks are being used by Nelson Nash's family as a way to transact. He went from being a borrower and being subject to harsh rules to becoming a banker. When Nelson Nash passed away, he was a proud owner of 45 policies in his lifetime. 17 policies were in himself, 2 policies were on business partners, and 26 policies are and still are on his family members. So his family banking, made of per whole life policies, financed every need they had: homes, vehicles, educations, and all the repayments they would have otherwise sent to a bank came back into the family pool. So all the interest stayed within the family's economy. And years later, after eliminating the high interest debts that he was going to become bankrupt from, he even financed a lawyer's airplane purchase. Just imagine. The same lawyer didn't want to hear anything about the concept. He had what Nelson Nash described as an arrival syndrome. But this same lawyer, came and borrowed money from Nelson to finance his airplane. And Nelson Nash took the same volume of payments and sent them in a policy in order to be recapitalized and used later. So the man who stood owing $2.5 million at 23% now is collecting interest as a banker. This isn't about avoiding debt. It's about you being in control of that debt by becoming your own source of capital. Maybe you felt almost the same amount of pressure that Nelson did. Maybe you just want to ensure that you build something where you never have to end up in a situation like this one. Either way, these principles that I'm about to teach you in this mastermind, they will serve you and they will help you if you listen with an open heart and act on it, because they rest on contractual guarantees. They don't rest on market guesses. So control will be in your hands, and it can be in your hands from the very beginning to the very end. So in this section, I'm going to talk about the problem this concept solves in every family's finances. Infinite banking, it allows you to never part ways with your money in order to spend it. You don't have to part ways with your money in order to achieve your spending goals. The basics of infinite banking concept, it teaches how you can recapture not only the interest, but also the payments that you normally give to banks and finance companies for the things you finance, like cars, homes, education, investments, business equipment, and life's major expenses. That's on page 3 of this book. That's the basic idea. That's how it was revealed. The very basic principle that needs to be understood is that you finance everything you buy. Every purchase you make is financed one way or another. Either you pay interest to someone else when you borrow, you can actually see the interest you're paying, or you lose the interest you could have earned when you pay cash. For example, if you spend $10,000 on a vacation today, you didn't just spend $10,000 cash, but you also gave up the growth that $10,000 could have earned if it was invested. So the alternate use of money is something that we need to recognize, because once you spend it, that money is gone. Not only that money is gone, but also the interest that money could have made for you. For how long? For life. Because if it is a loan, you can see the interest that you pay every single month. But if it is liquid cash like this one, when you give it away, when you just put it in someone else's banking system, that money is gone. You can't think of using it anywhere else. When this money is spent cash, what is the equivalent of the opportunity cost? Because as I was saying, if it's a loan, if it's credit, you can see the interest. But if it's cash, you can't see the interest you are giving up the opportunity to earn. And I'm going to take this opportunity and show it to you. Here is something that I want you to understand. Once you spend that money, if it's cash, this one, it's gone. Not only this money is gone, but so is the interest that money could have made. That money is gone for how long? For life. Perpetually, because the alternate use of this money, if it's not spent, has to be recognized. If it is a loan, if it's credit, you can actually see how much interest you pay when you are paying it back. But if it is cash, liquid like this, I'm going to actually try and depict for you what is this opportunity cost that I'm mentioning when you just send cash away. And most importantly, we'll see later how we can recapture that opportunity cost that is lost when you do such a thing. I'm going to now try to depict for you the true representation of the opportunity cost. And I will use ChatGPT for this to make it simple, okay? This is a full breakdown of what you'll see here. I was actually trying to show you that you finance everything you buy, that every purchase is financed one way or another. Either you do what? You pay interest to someone else when you borrow, or you lose the interest you could have earned when you pay cash. Now, let's take an example of someone spending $20,000 one time. When you look at this example, I want you to understand that it's going to help us in the case study that I will bring up for you. Because the case study is someone who is actually using $20,000 to achieve a certain objective, but he's not getting the full control over the usage and the liquidity of his money. But let's see if this person spends this money cash. $20,000 doesn't mean it's going to be spent once. That's not what it means. $20,000 can be split in 2 payments, can be split in 4 payments, can be split in monthly payments. All I know is most Canadians who are salaried employees or business owners, $20,000 will actually transit through their hands, through expenses, through purchases they will make, through paying what they owe. Now, if $20,000 is spent once, 10 years later, still is $20,000 that was spent. The future value that here we are talking about is $32,578. Of course, if it is invested at 5% compound interest, 5%, okay? $32,578. Meaning, if you spend $20,000 today, you are giving up the opportunity to earn $12,578 10 years later. It's a decision that you are making whether you like it or not. And if that same $20,000 goes today, 20 years later, we are talking about $33,066 of interest that you are giving up the opportunity to earn. Here we have $53,066 is to $20,000 plus the interest that was compounding over this period of 20 years. And if it's 30 years, $20,000 spent once, $86,439 of future value, meaning between now and the next 30 years, you are giving up the opportunity to earn $66,439 if this $20,000 was not spent that way. Again, once you spend this $20,000, you just don't lose the cash. You also lose the growth that cash would have earned forever. Now, here, this second example is someone spending $20,000 not once a year, every single year, not 10 years only, every single year. We're still going to see how the result looks like over 10 years, over 20 years, and over 30 years, okay? Now, over 10 years, if $20,000 is spent every year, that's $200,000 that transited through your hand. When this transits through your hand, it's gone again, it's cash, okay? And the future value, if invested at 5% over that same period of 10 years, the growth would have been $51,558. Meaning, if you decide to spend $200,000 instead of investing it at 5%, you are giving up the opportunity to earn $251,558. If it happens over 20 years, that's $400,000 that passed through your hand. The future value would have been $661,319 that you are giving up the opportunity to do what? To earn. And of which the interest is $261,319. Now, here's this. If someone does the same thing over a period of 30 years, $20,000 every year, $600,000 over that period of 30 years, that's $1.3 million. $1,328,777. And the growth that you are giving up the opportunity to earn is $728,777. What I want you to understand here is, over this 30-year period, spending $20,000 annually, that doesn't just cost you $600,000, but it costs you an additional $728 and $777 in lost growth. That's the total lost opportunity cost. That's what it costs. But that's what it costs you, not the banker. Because that money is still within the banking system, going around for the banker. Now, what I like about this concept is it clearly shows us how this $728,000, along with the $600,000 itself that we'll spend, how can this be recaptured? That's the interest that Nelson Nash is mentioning on page 3. That can be recaptured. Not only that interest, but also the money. All right? So this is the best way I can use to represent the opportunity cost in this example. This next part, I want you to understand where your money actually resides. All right? So I want you to picture a circle. Draw this circle. That's your bank account. When your income lands in that circle, it feels like your money. I agree. But I want you to understand that there is no vault box with your name on it at the bank. Your money, my money, all customers' deposits are pooled together. It's in one big pool of money. But the question that I have for you, do you believe for one second that the bank will ever let that money sit still? No. your banker will never let that money sit still. So you depositing money in that bank makes you a depositor. And the bank holding that money makes someone a banker. So two characters are identified now, the depositor and the banker. So bankers use your deposits to fuel their lending operations. Now, since we are trying to study how to become our own bankers, let's study how bankers operate. Banks turn deposits into loans, mortgages, and credit lines. They don't just figuratively do that, but they use our deposits. The money you deposit, they use it to fuel the lending activity. So the point is that money never sits still. Even when you transfer money from bank A to bank B, the system remains intact. That money never leaves the banking system. And there is no banking systems. There is one banking system. Banks themselves, they lend themselves money each and every day to balance their reserves. It's called overnight lending rate. So when you look at banks, don't look at them as enemies. They are partners. They are in the same ecosystem. And presently, in the Canadian system, this short-term balancing is done daily on banks. It's done daily through something that we call the overnight lending rate, set by the Bank of Canada, where banks can lend each other money. Now, let's come back to the money you flow through those banks. So when you spend money, when you are paying bills, debts, or investments, your money leaves your account, but it stays within the banking system. When you are spending it, you lose control over this money, but the bank still retains the use of those same dollars that you lost control of. You achieved your goal, but you no longer have the money, because for you, that money is gone. But for them, it still is, and it becomes an asset that can still earn interest on them, again and again and again. Now, here's the the everyday reality of the salaried employees here in Canada that I meet, and even business owners. The average salaried employee receives his income every 2 weeks, bi-weekly. So when I get to ask them this question, how long does that money stay with you before it's gone in expenses? Most say less than 2 days. And some have even said 7 to up to that week or a week and a half. They don't have a spending problem. They have a money flow problem. This person exchanged 2 weeks of time and energy for money that will leave them, for most, within those 48 to 72 hours. You work for 2 weeks, but that money will only serve you for those 2 to 3 days. Listen, you accomplished what you wanted to buy. You got what you wanted. But you no longer have the money. And while you no longer have the money, the banking system keeps winning on those same dollars that will pass through our hands once. They pass through our hands once, we earn that money once, but they earn interest on that same money over and over and over. You are only winning once by just achieving your goal. With your money, you can either spend it, save it, or give it away. Your paycheck comes in, it goes in, and it goes out. But for banks, they use those same deposits that they received to multiply it through lending it. So here's what the rich and bankers understand. And I will quote Robert Kiyosaki with this one. He said, it's not how much money you make, but how much money you keep, how hard it works for you, and how many generations you can keep it for. Wealthy families and bankers don't just let money leave their ecosystem. One of the first rules of Warren Buffett, in fact, the first rule is never lose money. The second one, always go back to the first rule. And the third one, always go back to the second rule, which is the first rule, which is never lose money. Rich people and bankers, they find a way to earn that money, to work once, but let this money earn for them perpetually. So let's come back to the concept. We identified a depositor. A depositor is the one doing all the work to earn the money and deposit it in someone else's banking system, okay? And there is a banker, the one managing and lending that money, okay? And there is also a borrower. A borrower is one who will qualify, the one who is going to access a loan and pay interest on the loans that were created by the deposits. That's the third character. And the fourth one, a bank owner, the one collecting all the profits from this cycle. This cycle of four people, it doesn't work with just bank owners and bankers. They need depositors and borrowers. So most Canadians play mostly two roles. depositors and borrowers. They do all the work, these two roles, these two characters, but the banker and the bank owners, they will come and reap the full benefits of what those first two did. But the real problem is the following. The people creating these deposits, you and I, we are the first one to do all the work, and we are the last one to profit from it, because money keeps leaving our control, but money never leaves the bank's control. Banks use those dollars multiple times in order to generate, to profit from it. And that leak that is happening in everyone's life presently, the ones who are listening to me, that leak is what infinite banking came to close. Infinite banking is designed to just tape that leak for that to never happen again. So the first thing that IBC will do, it will teach you how to not part ways with your money for you to achieve what you wanted to buy. You can still keep your money and still achieve what you wanted to buy. It's just that the way you are going to buy it is different than how most people do it. And you will be able to achieve what you wanted to buy, just like the banks do. They can never use their savings. They will use deposits, fuel lending operations, generate interest, and use those interests to achieve their lending goals. And that's exactly what banks do. They use other people's money by lending it out. And when they do that, when they lend it out, they earn interest, achieve their goals with the interest they earned without using their own funds. It's interest. They never deplete the principal. They use interest to achieve their goal. So if you want to become your own banker today, you need a system that lets you do that same thing that I just mentioned in your life. And that system today is called participating whole life insurance contract. Preferably, it will be better if it is issued by a mutual life insurance company, where you will be both a depositor in that same system, in those same contracts, and the owner. And later we'll get into how you can actually use it. But for now, let's keep exploring the problem that IBC is here to solve in families' finances. So here's why families can't get ahead. It's because of the hidden cost of interest. And I like how Nelson Nash depicted it, how he described it in the Everyday Family Budget on page 17 of his book, of Becoming Your Own Banker. So Nelson Nash breaks down how the average family's money flow through their hands. And he looked at how a young man, how the household income of that young man is typically divided. And he went on to divide a few things, okay? Now, on this part, I'm going to talk about why families can't get ahead in life. It is because of the hidden cost of interest. And it is something that if, frankly, you really want to become the banker in your life, you need to understand this part. It's really one of the most important parts of this book. And the title of this part on page 17 of his book is called The Problem. And he brought about the all-American family. Here he was trying to show that you don't have to be rich to become your own banker, because the example he took was really a typical example at his time. And I feel like it still is today, because it's not much different than it is today. And what I want you to see here is the following. He brought up the pattern of spending of this family, of this man. And he was mentioning that with his auto expenses, it takes about 20%. Okay, and with his auto expenses, here we are counting things like car payments, fuel, insurance. This is transportation, okay? And then he also mentioned that housing will typically take 30%, okay? With 30% here in housing, we're counting mortgage or rent and utilities that goes with housing. So that also goes in. And here he's putting together living expenses, food, childcare, clothing, all the expenses that goes with living expenses. He brought them up to 40%. Here he's assuming that this person will save 10%. Okay, that's what he's assuming in this example. Except that today, the current savings rate of Canadians is around 5%. But for the sake of this illustration, I'll keep it to 10%. And what Nelson Nash here is saying is most people can't conceive that this 90% is gone. This is money that is gone, that is never going to come back again. And they will try to only get ahead with this 10% in their lives. This is what they will use to get ahead in life. And the real question here that I beg to bring here, and that's really what struck me, is of this 90%, because we know people will finance auto expenses. We know people will finance housing expenses and living expenses with the banks. How much of this 90%? How much of this 90% is actually going to the goods and services, and how much of this 90% is actually going to interest? And in this very part, you will actually get to see the answer. Let me break down the interest, okay? So in Nelson Nash study, he showed us how roughly 35%, 35, how 35% of this 30% is going in interest. That's 35%. Not 10, not 20, 35%. Meaning, out of this 90%, if let's say it's $1,000, 350 is actually going into interest. The rest is going to actually go onto the goods that someone else is buying. So, what struck me in this example is the following. People are trying to get ahead in life with this 10% that is here, while they have 35% of their income working against them as a way of interest that goes to the bank. That's a ratio of one. That's like taking one step ahead and 3.5 steps behind with this ratio. Because saving 10%, if you do save 10%, and paying in the volume of interest to banks 35%, that's where it comes in. And that's pretty rough, all right? And I'm just going to bring up the example of mortgages, for example. Maybe that's where it will make sense, that volume of interest. So with this example, we'll find that most Canadians are left trying to get ahead with only 10% of savings, while 35% of their total income is enriching the banking system. And that banking system is financing auto expenses, housing expenses, and living expenses. As I was saying, that's just taking one step ahead, one step forward, and 3.5 steps behind. Okay? Let's look at how mortgages are structured, and that can keep some families stuck. Because in most mortgages, the interest is front-loaded. The first years of payments are mostly interest. Only in later years, you only get to see the principal reduction, where every dollar you pay get to actually be affected on that loan. And for example, in nominal values in dollars, for every $100 you pay early on, maybe $20 goes to principal, and the rest goes to interest. Yet the average homeowner will move at least within 5 to 7 years or refinance, restarting the clock at zero. When they were now starting to get ahead, when every dollar kind of gets close to what goes to the principal, that balances will start again. So the bank will keep collecting its lion's share, its big share, and while you are restarting from scratch. And to depict that even better, I'll use the airplane analogy of Nelson Nash. Try to picture your life, your financial life, as a plane flying at 100 miles per hour towards your destination. Now imagine a headwind that is coming against that plane at 350 miles per hour. A headwind that is coming against it. The plane can't move forward as it is intended, because it is going to be pushed backward than the speed is going at. That's simply what happens when you are saving 10%. That's 100 miles per hour, but losing 35% of interest to banks. That's the 350 miles per hour. Here, if you try to go faster with that plane, you might break. You don't need to go faster. You just need to find a way to change and control the environment you are operating in. And that's where most people feel stuck. Because what they try to do, they try to push harder, work more hours, seek higher returns, take on more risk to compensate for that interest, that volume of interest that they are losing to banks. But in this environment that is dominated with these amounts of interest, effort alone, the effort you do alone, won't fix it. Because you cannot outrun this financial headwind that is this strong. Now, the IBC perspective, the infinite banking concept perspective on this, is it teaches us that you can't always earn more sometimes, but you can control how the interest flows through your life. You can control the financial environment you operate in. Because when you reach that point when you control it, the 35% that was working against you can be added on the 10% that you're already saving, and that can transform from a headwind to a tailwind. Imagine redirecting that 35% into your own system instead of someone else's system. You'd move from fighting against debt to profiting from the financing that you were doing somewhere else. Because at the end of the day, you are the actor who is driving profit for banks. So if you were given a system where you can be the same actor but also the banker, that profit can stay with you. So that 35% that you pay in interest is just a series of payment. It can be redirected strategically. So when I'm talking about strategically, it is when we structure properly your own banking system using these participating whole life insurance policies. Because these payments, whenever they are done in these contracts, they kind of build equity. And that equity will be used and will grow. And on top of that, dividends will be added in. So that becomes like a compounding factor. Because over time, those same dollars that once left your life as interest can now stay first, grow first, and compound over time. And that compound is going to happen without interruption. But now I want to invite you to see the bigger picture. Because the average family unknowingly finances the profits of banks twice. That's how I view it. At first, they will finance the bank's profit through the interest on debts, cars, homes, credit cards. That's the first way. And the second way, they will finance the bank's profit through the deposits that they are putting in. That fuels the bank's lending operations. Two ways of just making the banks win. Both flows of money, the ones that I just mentioned, they will flow into the bank to profit for the bank owner, not the family who earned the money and who is doing all that work. So the most logical question in this scenario is the following. When will your money finally work for you and you alone? Because you are the one who earned it. Who should benefit the most from it? And that's why infinite banking is a mindset shift. Because if presently you are facing financial pressures today, you won't really escape it with the same thinking that created it. You need to pause and actually think, how did I get here? And am I actually using the same tools that got me here to get out? If yes, then you need to think differently. And the infinite banking concept is here to help you think differently. Because it isn't about addressing a rate of return. It's about who is the banker in your life and who is controlling that function called banking. Because once you become the banker in your life, every dollar you earn will be useful to you and for your family. Not once, but more than once. Because in reality, you were always the depositor again. And you are the borrower presently. You've just been doing these roles inside someone else's banking system. Now it's time to shift how we think and find, okay, if there was a banker and a bank owner, where can I find a system where I can be both characters? And when you learn this concept in this mastermind, how to use participating whole life insurance contracts, something will shift. You start earning the interest you used to pay. You start earning it, in your own system. You start owning the profits that once belonged to the bankers and the bank owners. It is very simple. It does not need to be more complicated than this. So this is just not a financial strategy. It will be peaceful and it will be a stress-free way of life once you start implementing it. Because the peace of mind knowing that every dollar you touch continues to serve your family again and again and again is what you just needed to keep winning every day. So let's get on the next part and I will show you more about this concept. Now, I'm just going to show you who really owns your savings or the illusion of control. You may think you control things. Maybe you do, maybe you don't. Let's see. So I will start on these ways. Most Canadians believe that the safest place for their money to reside is in a bank or their savings in a registered plan. But your wealth doesn't have to live in a bank A or bank B. Banks exist for your convenience, mostly for transactional convenience, not for long-term warehousing of your money. Initially, they were made to facilitate transactions. Now, the infinite banking concept challenges that assumption. by asking who really controls where your money resides and who still has control of it once it leaves your hands. And I'll particularly bring it to this discussion. So for most Canadians, when they meet advisors at the bank or at an insurance company, the conversation is always product driven. It's always solution driven or product driven. If you are worried about your retirement, the first advice you will receive: save in this tool called RRSP. Let's open an RRSP. You want to save for retirement? An RRSP is the best way to go. Oh, you have kids? You'll need an RESP. And frankly, these programs aren't good or bad. They are just government-regulated tools, and they are designed to meet those specific objectives. But the problem that I have here is that most people, they hand over control of this money without really fully understanding how these programs actually function and who benefits the most in these programs. Let me start with an RRSP. What is an RRSP and what does it do? So according to the Canada Revenue Agency, an RRSP is called a Registered Retirement Savings Plan. It is a retirement savings plan that you can actually build, that you can establish, where you or your spouse or a common law partner can contribute. So whenever you make those contributions are deductible from your taxable income. And the investment that is growing within those RRSP is tax deferred until withdrawal. I repeat, the investment you are making in these RRSPs will actually grow in a very tax deferred way until withdrawal. But withdrawals, though, they are fully taxable as income in the year you take them. So the assumption behind this plan is the following: your income will be low in retirement. Not only your income, but also the tax rate will be lower during your retirement, because this account is for retirement. But this assumption may not be true for everyone, especially for someone who is considered a high-income earner or a business owner who is expecting a steady growth of income later in life. So since RRSP was created as something to give people a tax break so that they can save for their retirement, let's actually go back in history and find out how tax started. And here's how it went. The Canadian income tax was introduced in 1917 as a temporary measure under the Income Tax War Act. This income tax that was introduced was never abandoned after the war finished. In fact, it became permanent. So what started as temporary became permanent later. Now, when the government runs out of money, it only has two choices. It either thinks of making more money by raising taxes or spend less by cutting jobs and programs. And when the government spends more than it earns, it will want to keep money circulating in the system in order to keep earning more money. And it will want a promise of future tax income as well. So RRSPs can help with both. RRSPs will keep your money locked in financial institutions today, and they guarantee the government that they will tax it later at a potential high rate when you take it out. Now, I will just use these logical questions or logical facts around RRSPs. So here's a few facts. The government created a problem, high taxation, and then it turned to us to offer a solution, tax deferral through RRSPs. But you know your tax saving today. You know exactly how much you are saving on tax today when you put money into your RRSP. But you don't know how much tax will cost tomorrow, because tax rates are not contractual. They don't stay the same. They are subject to change. There is no guarantee they will be lower when you retire. And there are absolutely no guarantees that your RRSP will have performed well through the volatility and the market changes. Now, here's a question, and this question relates to control. Who contributes into your RRSP? Yourself. Who determines, who can make the choice of when you can actually access it and how you can access it without being penalized? Not you, even though you did all the work to contribute into this plan. Because as we know it, RRSPs, whenever you go and withdraw it, it's really tightly regulated. You can't just do anything about it. Two plans allow you to access money into your RRSPs. Home buyer's plan, up to $35,000 can be withdrawn, but it has to be repaid in 15 years. Every missed repayment on every year will be added as your revenue and it will be taxed. The second way is life learning plan. up to $10,000. Even now, I believe it's now up to $20,000. Okay, but it's also repayable. Any other withdrawal that doesn't concern these two will trigger penalties or withholding tax. And in most provinces except Quebec, if you want to access 5,000 or less, 10% will be held. Between 5,000 and 15,000, 20% will be held. And over $15,000, 30% is going to be kept by the bank. So when you face a need of liquidity, people often go and borrow from banks instead of withdrawing from RRSPs because of these penalties. And they end up paying interest to access their own capital while the bank continues earning from their deposits and, of course, making investment fees as well. It's interest and fees. But here's the irony. The same dollars you saved for future are used by financial institutions today to fuel their lending activities. And they will generate profit, and that profit will actually go to the bank owners, not to the depositors who are making the real things happen. And here is an unspoken truth by most people in my industry. Your RRSP contributions will become actually someone else's working capital because financial institutions will actually invest those funds. They will earn management fees whether your investment grows or not. You are served with probabilities and they are served with guarantees of profit. For you, there is absolutely no guarantees to talk about whatsoever. And the growth of that RSP, we have no guarantee that it will outpace inflation after fees and taxes. It really will depend heavily on investment choices and the market performance. Meanwhile, most Canadians will still have the need of money. They will have to borrow for major purchases. They will pay interest on the money they borrowed. But that money could have been under their control though, but it's not the case. The case here is your money gets locked away, you can't touch it freely, and you are the one taking all the risk while someone else decides how it's used. And the banks and the government, they will just stay in control. You are just the one with the only commitment. So most people were taught that this is one of the safest setup. But the truth is, real safety comes from being in control of your own money, not giving up the control over your own money. Because if you worked hard for the money, who should it serve first? Who should benefit the most first? You or the institution holding it? Because until that changes, most Canadians will continue to finance banks through interest and feed banks through deposits. Now, here's what Infinite Banking reveals. IBC doesn't say don't use RRSPs. No, it just says understand the cost of control whenever you give it up. And if you do understand that control, just find measures to take that control back. Because you can choose to build a system where you can make the same kind of contributions, and yes, you will pay your taxes today, but you will never ever have to pay taxes on the money that goes into that system ever again. Not during retirement, and not even after you are no longer on this earth. In this system, no one limits how much you can contribute. In this system, your growth keeps compounding without interruption. Even when you access your money, you do it without interrupting the accumulating values. So the logical question in this case now is, if something like this existed, if a system like this existed, a place where your money can grow, your money stays liquid, and that money remains under your control, ask yourself, what other logical place would there be for your wealth to reside? Now, I'm going to address RESPs because you can have good intentions to put money into an RESP, but ultimately, even though you have good intentions with it, it can limit your control. And many parents are told that the best way to prepare for your children's education is to open an RESP, a registered education savings plan. And this idea, frankly, it sounds perfect. Listen, you put money in every year, you get free money from the government, and you can help your child go to university at a time when he needs it. But very few parents stop to ask, what do I lose in control when I do this? What do I lose in control when I do this? Because here is how our RESPs work. The maximum contribution limit within RESPs are up to $22,500 per year per children. And when you do that, you will earn a Canadian education savings grant, which means they will match your contributions up to 20% or $500 in that year, except that the maximum federal grant of that CESG over your children's lifetime is $7,200. So if you are contributing for 17 years, it's about 14 years that you will only get that $500 a year. And in provinces like Quebec, BC, and Saskatchewan, you can actually get provincial top-ups from the provincial government between 8 to 12,000. So the most you can really get is that 7,200 and that 12,000. Okay, so that's like 19,000 overall, like the maximum. RESP investments, they really grow tax deferred. No problem over there. But whenever they are withdrawn for education, the grants you received plus the investment growth that took place during those years, they will be taxable in the student's name. And if your child doesn't pursue post-secondary education, those amounts must be repaid to the government. And the growth may be taxed in the parent's hands, in the parent's name. But truthfully, here is the parent's reality. You may contribute faithfully for 17 years, only to see that money used over 4 or 5 years of school. 17 years of money accumulation and 5 years of money being spent. And during those 7 years, you can't really access that money if you don't want to interrupt the growth. You can withdraw only what you contributed, the capital, not the grants, not the growth. It's without penalties, but you forfeit all these benefits, which can also feel like penalties. So even if life will present opportunities or financial strain, if you were to feel financially strained, let's say you are buying another property, you need closing costs, you are expanding your business, that money is off limits unless you want to lose the benefits and the growth. What do most parents end up doing? They end up borrowing somewhere else. They end up borrowing elsewhere, while thousands of dollars of their own money is sitting into an RESP, they end up borrowing. So when that situation happens, and it is most likely that it will happen within those 17 years, while your money sits there, it is still pooled and invested through financial institutions. Again, as I said before on the RRSP, those institutions, they will earn management fees on the RESP investments, regardless of the market performance. They are served with guarantee of revenue, and you are served with a probability of profit. While you are giving up access and control over that money, someone else keeps earning from your contributions in those 17 years. Now, let's zoom in actually on the short window that money is being used for. Because you saved for 17 years so that your children can use that money for only, let's say, 5 years during university. But after graduation, that account closes. It's done. Your children starts financial life from zero. He starts from zero unless you have something else set aside for him. Because RESP is done. It's gone. Meanwhile, your needs, your family's financial needs will continue. Mortgages will continue. Businesses will continue. Retirement will still be needed. Yet the money you saved was never available to help. It was only saved for 17 years to only answer a need of 5 years. And the fact of having an RESP can have some type of impact if you wanted to tap into the student aid. Per the rules of OSAP in Ontario, for example, and most provinces as well, student aid programs, they will actually consider parental income and RESP balances when they want to calculate how much bursaries they want to give you. And if a student has an RESP, grant eligibility drops. You are offered a large loan and smaller bursaries or no bursaries at all. That means the money you saved could actually reduce the amount of non-repayable aid that your child would receive from the government, because the government can actually see what's in the RESP because it's registered. But here is a different way to think about this. What if your savings could grow for 17 years, still 17 years, but still during those 17 years, those savings are accessible when life happens or when an opportunity knocks? And what if your child could receive bursaries instead of loans because your savings, your money, the ones you're saving for 17 years, was not sitting in a registered plan visible to the CRA and the government? And what if after university, that same pool of money, the ones you've been saving for 17 years, what if that same pool of money was growing and that money was ready to help your child buy a home or start a business? Or even better, eliminate all the loans he must have accumulated during universities at 0%. But based on IBC principles, if you were to direct that same $2,500 per year into a participating whole life policy on your child, here's what you can do, and here's what you can achieve. Control will be yours. We'll keep control, and you can access that money anytime you want. That money will be used to purchase a policy, and those policies will release what's called cash value. And again, that cash value will grow on an uninterrupted compound interest basis. And if you need to access that money, you can just borrow against it while not losing the compound it's doing. And you can use it later to help your child pay off the student loans or start their own system in life. So the same dollars you were willing to lock away for 17 years can now work not one time, but it can work continuously for your family, for your children's education, for home ownership, for retirement, and for many generations to come. Man, now, here's the takeaway that I want you to get out of this. The issue isn't that RESPs or RRSPs are bad. The real issue that I'm trying to tackle here is you just get offered a tiny window of use, and while doing that, you take away a lifetime of control. Money that belongs to you should be available to you and should keep working for you and your family forever. That's just simple. What I'm going to address on this section is, where do banks save their money? Where do they warehouse their own personal money? Not your money, their money. So when most of us walk into a bank, we are told to put our money into things like RRSPs, savings accounts, investment accounts, non-registered, RESPs, TFSA, many accounts. When you carefully take a look at where banks themselves save their money, store their money, it's not in those tools that I just mentioned. And by reading the public financial statements of major Canadian banks like RBC, BMO, and CIBC, something stood out on all of them. There was a large line item called bank-owned life insurance. It's called BOLI, bank-owned life insurance. And what BOLI means is the following. It's a type of permanent life insurance that a bank buys on its key employees or executives. The bank is both the owner and the beneficiary of the policy. And the policy's cash value inside of the policy, they will grow tax deferred. They will earn a steady return for the bank, and that will be considered just a low-risk asset on the bank's balance sheet. The cash values that I just mentioned that will grow in a very tax-advantaged way, they will appear on the bank's balance sheet as an asset, all right? And I'm going to share my screen here and show you exactly what happens in these banks. They mention other assets. This is BMO, right? This is BMO. They mention other assets, and when they mention other assets, what they do here, they come and give us a financial statement. And within this financial statement, which is in Canadian of million of dollars, they will show us here bank-owned life insurance policies. And in 2024 alone, the bank-owned life insurance policies of BMO were at $6,350,000,000. That's a bank today. So when you see a financial statement like this one, I want you to notice something here. It's in Canadians of millions of dollars, and out of the biggest places that the banks will put their money, the very first place here, at least in 2024, will be the precious metals. They will have about 9.4 billion. And the second place will be the cash collaterals, will be about 9.4 billion. But there goes BOLI, bank-owned life insurance contract, as you see them, bank-owned life insurance policies. It's $6,350,000,000. Last year alone, it was what? $6,306,000,000. And this constitutes 14% of 42 billion that they have in the category of other assets. Just think about it. BMO is the only bank that I was able to find with real numbers. I went into other banks, they will just mention it, but no numbers. Here they even mentioned bank-owned life insurance, and they clearly mentioned that the fair market value, the fair value of this bank-owned life insurance is this cash surrender value, which is also called cash value. Okay? So in RBC, they also gave us something, but it was only clearly mentioned, but not like with numbers. So why does it matter for banks to have these policies on their balance sheet? Because certainly they are not doing it for death benefit protection. That's not their first goal with these policies. They are doing it because they understand, first of all, what is the value of having a cash value that grows as an asset predictably, tax efficiently. They understand how much that can consist of a safety on their balance sheet. In other words, the same principle Nelson Nash taught, becoming your own banker, is already being practiced by the largest banks in Canada. And now, there comes a double standard. Banks will tell individuals, put your money into registered plans, lock that money up, and we'll manage it for you. But on their own books, on their own reserve, they will purchase participating life insurance contracts in billions. They will record the cash values of those contracts as an asset. And they will use that asset that is recorded as a long-term private reserve that will keep compounding safely. No market volatility, no taxes, nothing will impact it. They don't go around bragging about this. It's just buried deep in their financial statements. Now, the logical question that is begged here is, why would multi-billion-dollar banks decide to warehouse their money inside life insurance policies if it wasn't one of the most efficient, stable, and tax-advantaged assets available? Why? Are they doing it because they just don't care, or they are reckless, or they are doing it because they understand exactly what this tool can do? And here's my take. If it's good enough for these banks, if it's good enough for the bank's balance sheets, isn't it worth learning how this very tool can serve your family's balance sheet? I want you to take this away with you. This isn't about envy. It's about putting out and making everyone know that this is possible. Banks already become their own bankers by using these policies. And the infinite banking concept, it gives everyday Canadians a way to apply these same principles in their life without needing to be a billion-dollar institution or without needing to start with a lot of money. The meaning of life insurance now will have two perspectives. To the average Canadians, the word life insurance sounds like a deal where you must die for your family to win. It sounds like a deal where you must die for your family to win. But to banks, when they hear bank-owned life insurance, they think of an asset. That's where they think first. Something that works while the one who is insured is still alive. And again, I'm going to mention BMO. It's $6 billion tied up in cash values on their balance sheet. That's not money waiting for someone to claim it at death. It's money working right now, earning returns today. And that is strengthening their balance sheet, their reserves. So the reason why banks see it as an asset, and simply, before we get to see why, it's an asset is something that you can buy. An asset is something that you can sell. An asset is something that can grow in value. And an asset, finally, is something that you can generate revenue from. And frankly, bank-owned life insurance in this concept, it checks all the four boxes. It can be purchased. It can grow everywhere. It does grow every year. It can be leveraged to access liquidity. And it even produces consistent tax-advantaged income. And inside that bank system, just money stays there and money stays growing. So banks recognized that opportunity decades ago. They've held these contracts quietly since the 1800s. Now, these policies, I want you to understand that they were not created by banks. They were not created by financial gurus or marketers. They've existed in Canada since 1842, long before any of mutual funds, RRSPs, or modern banking as we know it. They were designed to solve money problems. And to solve those money problems, not when people are gone, while people are alive. And the good news is, the infinite banking concept is just simply revives the original purpose of what these tools are intended for. Meaning, using the same kind of contracts bank use to strengthen their balance sheet. It's just that the real difference is, for you, if you live a long life, you will win because your money keeps working for you year after year, compounding without interruption. And if you pass too soon, your family wins because they will inherit far more than what you can ever put into that policy. Either way, you will win, or your family is the winner. And guess who becomes the loser in this scenario? Not you. Banks, government, and the CRA, because they will never be able to touch again any dollar that goes into that system. Because every dollar that goes into that system will stay in that system, will work for you while you're still alive, and you will have control over the access, the use, and liquidity of that money. You win first and you win last. Now, we are going to get into a case study. We've talked enough about the concept. It's now time to see a real case study. And the case study that I'm going to bring today is Lukas and Emily. Lukas is 35, Emily is 33. They are married with 2 young children. By the way, these are actual clients of mine in my portfolio. So their financial habits were they were saving $5,000 a year in a TFSA in order for whenever they need liquidity, they can access it. And they were also putting $15,000 a year into their RRSP and RESP split for retirement and their children's education. So when we met in early 2024, they also wanted to buy a new car, a larger one for their growing family. So their choices for the car, they had 3 possible ways to purchase that car. And most of those ways, we've already explored them. But we are going to see exactly the option, what happens with that option, and who controls it. Option number 1 is cash. With cash, they lose the money, and they also lose the future interest that money could have earned. Yes, they got the car, but they no longer have the money. They lose control. With a bank loan for the car, they must qualify, pay interest on that loan, and follow the bank's repayment terms. So banks still stays in control. And what about leasing? Leasing is sending money away for years, and it's for a car that you will never own in the end. Still no control. Whether it be credit, cash, or leasing, they are sending money away for years. They are sending money away forever. And that loss is permanent. So when I asked, how many cars have they owned so far? How many cars have they bought, driven in their lives? Both of them, Emily and Lukas. They said 4. And each car was at least kept for 6 years. Now, if they intend to keep this new car and ongoing cars for another 6 years each, that will be about $30,000 per car. And if it's 8 cars, the principal for those cars will be about $240,000. And the total comes up to be $432,000 that will leave their control over that lifetime, only on the principal of the cars and the financing. That's more than they will ever save in their RRSPs and TFSAs combined. The real question that I asked here is, would you be open if I could show you a way how to build a $1.7 million tax-free asset in your lifetime using the same $20,000 per year you were already saving somewhere else in TFSAs and RRSPs and RESPs, and we're going to achieve this without working harder, without losing control over your money, without adding on more stress in your life. We will not absolutely change the goal, but we'll just change the vehicle by which we use to achieve those goals of retirement and education. But that goal will be achieved. And the tool we'll use to achieve that goal is exactly what we've been talking about since the beginning. Dividend paying, participating whole life insurance contract. And preferably with a mutual life insurance company, because that's when you become the real bank owner. And Nelson Nash liked to call it a death benefit thrown in for, it's a banking system with a death benefit thrown in for good measure. And I will just break down each component of these tools. The first component are premium. And premium are just deposits in your bank, in your banking system. Every policy requires premium to fulfill the contractual guarantees. They may be monthly premium or yearly premium. And those premiums now will be deposits in their own banking systems. So today, Lukas and Emily were sending $20,000 per year into someone else's bank through TFSAs, RRSPs, and RESPs. And when that money is sent, who holds and controls the money while the money is still in the bank? Of course, the bank. And when the money is in the bank, Who earns interest on it? I mean, the interest they earn on most of these accounts will stay inside until they withdraw it. But while the money is in there, it will earn more interest for the bank owners and dividends for the bank owners than it will for Lukas and Emily. Since that money is leaving their control and that becoming the problem, now the premium now is the solution. The premiums are deposits that you will take and deposit in your banking system. And in the case of Lukas and Emily, the premium on a yearly basis will be $20,000. And this is the same amount of money that was going from their account into someone else's account, into someone else's bank account. Now, the second component of these contracts is something called death benefit. It's the life insurance amount that you have, the family protection over the insured. The owner of this contract is Lukas, the insured is Lukas, the one who is paying is Lukas, but the beneficiary is the wife. So when something happens to Lukas, a big, large, tax-free check will be cut out to Emily's. The third component is cash value, and cash value makes up this concept called becoming your own banker. It's a living asset, and cash value is the capital that builds up from day one. And this asset will have to grow daily. I repeat, daily. You can actually see it grow daily. It will grow tax-free because according to the contract, this cash value has to be equal to the death benefit by age 100. You can access it anytime by the way of policy loans because it is your equity in the policy. And by definition, cash value means just an advance on the death benefit. It is the present value of the death benefit today. It's like if the life insurance company will say, hey, we're not going to wait for Lukas to pass away, but we're going to take an advance on the death benefit that he has on his head and give it to the family. So cash value is guaranteed, and it will always follow the death benefit because they have to match at age 100 contractually. It can't change. Now, the first component is called dividends. And dividends are your share of the profits. Because when you own a participating whole life insurance contract with a mutual life insurance company, you become a co-owner of that company. So a mutual life insurance company doesn't have any stockholders. So whenever profits are generated, and they always do, those profits are shared between the policy holders because they are the ones who co-own the company. So in this case, dividends, they are based on the company's profits, and they are also based on your contribution level. So in a properly structured life insurance, dividends can be received tax-free. You won't invite the tax man at all. And the life companies that we prefer to use, they've always at least paid dividends every year since at least 1847. They've never missed once. Now, how do you access money in that policy? How do you access your cash values? So there are 3 ways to access that cash values that you will build. The first way is just the full surrender of your policy. You can cancel the policy and you can take 100% of the cash value with you, but you will lose all the protection and future growth. And it is certainly not what we advise. The second way is pulling out the cash value just like from a bank account, withdrawing it. When you do so, you will stop the compounding that will happen on the cash value. The third way, which is what we generally recommend, is a policy loan. And with a policy loan, you can borrow up to 90% of that cash value that is ever growing. That cash value will act as a collateral, and you will get money from the life insurance company that you co-own, and a loan will be registered against the death benefit that is on your head. So the way policy loans work, you don't borrow your own cash value. You borrow against it. The insurance company will use its own money and will put a lien on the death benefit that is on your head. So if you pass away with an outstanding loan, the loan is simply deducted from the death benefit, and the rest goes tax-free to your family. Here are the most important facts about policy loans. And these are important because whenever someone hears a loan, they think it's the same type of loans they receive. So these policy loans, they never slow the cash value growth. And these loans, they never reduce the death benefit while you're still alive. And these loans, they never affect the dividends. And most importantly, whenever you contract these loans on your own terms, it will not go and appear on your credit reports. This is a private loan between you and the life insurance company that you co-own. And the terms of repayment of that loans are set by you. The life insurance company will never send you a statement at the end of the month saying you owe us this amount. And the interest of that loan, is charged by the life insurance company that you co-own. The same life insurance company that you co-own that lends you money will start accumulating interest, and that interest is compounding just once a year and is accumulated daily. So why does this matter for Lukas and Emily? It's because they need the car. They will not have to choose between cash, credit, or leasing. They will be able to borrow against their policy, and the cash value within the policy will keep compounding. They will repay in their policy just like as they would have in a bank, but on their own schedule. But they will still own the car outright. I want to remind you here the case about Lukas and Emily. They were already putting $5,000 in a TFSA, and they were already putting about $15,000 a year split between RRSPs and RESPs. And they were planning to finance the purchase of their car. And the cost of financing was going to go the following. They were planning to access $5,000 in their TFSA and finance the rest by the way of a bank loan. And that loan, the terms will be about 6 years or 60 months. And during that same period, every single month, $500 was going to have to go to the banks every single month. Now, here is the IBC difference. Because I promised them that by doing what I'm going to show them, that they will actually be able to build a $1.7 million asset that they can spend in their lives before they die. Lukas will not have to die before he gets to spend this $1.7 million asset that he will create. And we will use these same liquidities that are passing through his hand. And everything begins with the right tool. And I built the tool for them. I built a tool by which $20,000 can go in every single year. Every single year, $20,000 can go in as premium. And in these premiums, they are not obligated to put $20,000 in this policy every single year. The minimum required every single year is this $4,400. $4,400 is required to go in every single year. And they were not afraid to capitalize money or premiums this way because $5,000 was already going as TFSA anyway. It's just changing where it's going now. It's no longer going into a registered plan. It's going into a plan that is not registered. In fact, this plan is private. And when they do it this way, $4,400 goes in as required premium and $15,600 goes in as what? Optional premium. This optional premium, whenever it goes in a policy, it just buys more death benefit. And whenever more death benefit is bought, it brings up dramatically the cash value that is available to be borrowed against. And it will go exactly like this. Remember, when I met Emily and Lukas, they were planning to buy a car in that same year. But due to the way I built this plan, they had to wait for another year before they purchase that car. Now, I'm going to show you what was the outcome, and you'll let me know if it is something that was worth waiting for 1 year before they purchase it by using this policy. So, coming back on this example, when Lukas purchased this policy, the beginning death benefit was $500,000. $500,000 is what was the beginning of the insurance, okay? But when $20,000 went in the first year, the very first year, when $20,000 went in, the life insurance increased from $500,000 to $566,000. That's the increase that happened within that same year. And when $20,000 goes in, cash value within that same year will grow up to $18,033. It doesn't mean that they will have to wait for a year before they access this. As they put premiums, as cash value becomes available. Whenever cash value reaches $500, whenever the available amount, because remember, they can borrow up to what? Up to 90% of the cash value available. So whenever 90% of what's available is $500, they can actually borrow that money and use it for whatever they wanted. So here, in this example, they had to put this money in this policy for this year. But obviously, the maximum they will be able to borrow against in this policy is $18,033. How much went in? $20,000. But $16,000 is what they can borrow. It's exactly 90% of the $18,000. But $16,229 is not enough to buy a $30,000 car. That's why the decision here was to wait. Because according to them, and according to what I've shown them and what they've seen, it was worthwhile. So in year 2, which is this year, they are close to the end of the year. In year 2, now Lukas is turning 37. $20,000 will still go in the policy, as this money would have gone into a TFSA or RRSP or RESP, and cash value will grow from $18,000 to $37,000. The total annual increase of the cash value from year 1 to year 2 is $19,548. Their death benefit increased from $566 to $632,000. So in year 2, they have $632,982. The reason why I put this in red is because this is not for Lukas. This is for Emily and their 2 young children. And within this second year, right here, the dividends that they received at the end of year 1 was $929. The dividend that they will receive on that year at the end of year 2 is $1,428. And now, what happened here is cash value increase from one year to the other. And cash value went from 18,000 to 37. And when I calculate 90% of 37,000, that's 33,822. That's how much they can borrow without interrupting any of the accumulation that is happening on this remaining cash value. This loan will never be reported to TransUnion. This loan will never be reported to Equifax. They will control the repayment terms. And if they decided that they don't want to make a payment for 6 months, nobody will run after them. But deciding to make a payment now of money you borrowed in this policy, that's where this concept comes in. Because when you know that you would have made this payment at a bank, but decide to not make payment because this is your own money, you are simply sabotaging your own financial banking system. Make payments in this policy as you would have in a bank. And we'll see how this will change their lives. So in the second year, they will take a policy loan of $30,000 that they need. This is the one. And remember here, they were intending to pay $500 to a bank every single month without fail. So I don't see any reason why they can't do it here, because it is also a banking system where they deposit, they borrow, they are the bankers, and they're the bank owners because they get these dividends every year. So when we look at this, we'll see that in the second year, the very second year, they started making the payments of $500. And they made those payments as they would have in a conventional banking system. So here, I'm going to attract your attention on this point. $5,000 here was in a banking system. $15,000 was in an RRSP and RESP. So this money was in the control of banks. And this money too was in the control of banks. And this money was about to start going in the control of banks. But when we look, what's happening here is the money that was supposed to go into RRSPs, RESPs, TFSA is going into their own personal monetary system. And the money that they were intending to use to send to banks forever is also going back where? In their own personal banking system. All the dollars that they would have otherwise sent to banks are coming back here. Not only the dollars, but also the interest that goes along with these dollars. Whenever they purchased the car for $30,000, they purchased the car outright. That car was bought cash. If something were to happen to Lukas in this second year, the family would have received $632,000 minus the $30,000 that they borrowed and minus the interest that was accumulated, which will be not that much, but it is something that we can consider here. So about $602,000 would have gone to the family. And out of this $602,000, how much did they exactly put in the policy in these 2 years? $40,000. Do they have a paid-off car? Yes, a car of $30,000. Do they look that they are winning, or do they look that they are losing? I'll wait for your answer. So here, I'm going to continue with this, and we'll see. They continued making premium payments along these years. From year 1 to year 7, they continued making payments. They will continue making payments. And I want to show you what will happen when they continue making payments. Because that's what this policy does now. They continued making premiums of $20,000, and they also continued paying this policy as they would have otherwise done it in a bank. Now, when we try to calculate what is the amount of money they actually put in their policies here, when we try to look at it, we'll see that the premiums for the first 7 years were $20,000 a year. For times 7, that's $140,000. The policy loans, $30,000. That's exactly how much they borrowed in their policy in year 2. And the amount of repayment they did in these policies, it's $36,000. So the net outlay from year 1 to year 7 was $146,000, because you will take into account the $140,000 that went in, the $30,000 that went out, and $36,000 that went back in. And 140 minus 30,000 plus 36,000, that is 146,000. And what I want you to observe here is the following. What is the cash value? What is the net cash value available to be borrowed on year 7? It's 156,000. This is how much they can borrow without asking anyone's permission, without the need of being pre-qualified or meeting some debt to income ratio. They don't have to do any of that. It's complete control. And nobody is going to even set the terms of access of this money, and no one is going to even set the terms of repayment of the loans they will access in these policies. So what if these clients had not met me? What if these clients had not met the beauty of this concept? What would have happened to their RRSPs, RESPs, TFSAs? I tried to depict it here just on the side. So if they had accumulated money into their TFSA for 7 years, accounting for the withdrawal of $5,000 and accounting for the growth that would have happened, and I'm assuming no withdrawal took place, they will be today $37,500. It's $5,000 per year for 7 years, minus $5,000 plus about $7,500 of growth of interest. And if they had continued to put money into their RRSPs and RESPs, today, let me just consider the RRSPs to simplify the case here. If they had continued to put this $15,000 into the RRSP, the total amount today will be about $115,000 after 7 years. And all this money are in these registered accounts. And of course, they would have paid to the banks the car loan they would have borrowed of $36,000. I want you to understand that of all this money, of all the money that we see here, the car loan money, this money is gone. And if they say that they want to access money by the way of these RRSPs and TFSAs, the only accessible cash without really being penalized is their TFSA. And if they are okay to be penalized on the access of this $115,000, of course, 30% of this $115,000 will belong to what? To the bank or to the government, the government. The government will come and they will collect their share of $34,500. And they will be able to retain as cash $80,500. We take $80,500 plus the $37,500 they can access tax-free. That's $115,000 of money that is available. But what is their outlay? It's $188,000. So who did all the work to work for this $188,000? It's Lukas and Emily. And how much is accessible without being penalized? $37,500. What if they want to be penalized? It's $118,000. Compared to this couple of Lukas and Emily, the same couple, but they did it differently. After the same years, after the same waiting period of 7 years, $156,746 is available and it is still growing. The dividends they are receiving at the end of that year alone is $4,390. The death benefits is at $965,263. This year alone in year 7, $20,000 went in as premium, and the cash value growth from year 6 to year 7 was $26,793. Consider this. Whenever they were depositing this $20,000 in someone else's banking system, Were they getting an annual increase of 26,793? I don't think so. But who was getting this annual increase? Through dividends, the bankers and the bank owners, because they own the system and they operate the system. Now, Lukas and Emily will go ahead and maybe the car they purchased 6 years ago of $30,000 is now worth $15,000, even though it's paid cash, it loses value. They can borrow another $30,000 out of the 156 that is available and go purchase another car by trading in this one. Now they will be driving a $45,000 car, a much better car, paid off, and all the payments that they were going to make otherwise to a banker are going to come back in their own banking system. Is there any other peaceful, stress-free way of life, of dealing with their situation than this one? Because here, just for the sake of illustrating the power of these tools, I illustrated that here, he no longer continues making the required premium. That's my illustration. He no longer is required to keep doing this 4,400 that he was going to put in every single year, and that he did in the first 7 years. He will only put the minimum required, not the extra. But still, in the 8th year, when Lukas is 43, whenever 4,399 goes in, cash value inside will go from 156 to 169. That's $13,000 of growth. The question remains the same. Was he going to get the same treatment in a conventional banking system? Was he going to receive a dividend, a tax-free dividend of $4,736 in a bank? No. What if he continued putting in $20,000? What would have happened in year 8? Cash value would have grown to 156 to 185. That's 20,000 that went in and 28,000 that grew in that same period of time. That's complete financial control. So here, Lukas and Emily will continue financing the same cars. It may not be cars. It may be cars. It may be vacations. It may be whatever they want to finance in their lives. As time went by, they gained control. And as time keeps going, they will never need the bank for anything other than the convenience of debit. Unless if their needs now goes over what they can borrow here. Because either way, this money that is flowing through these policies, this money was going through the books, was going to flow through the books of someone else's bank. Now, I promise that if they continue doing this, they will build an asset value worth $1.7 million. And I want you to evaluate something here. By year 34, why am I going up to year 34 right now? It's because the need of money for this family is going to remain as long as they're still alive. And their money will still need to reside somewhere. If you are listening to me right now, and you think that thinking 30 years ahead of time is too far, remember, when you get to that year and you are still alive, you will still need money. You will still need a warehouse of money. You will still need a bank. You will have to choose if it's your bank or someone else's bank. Because if Emily and Lukas chooses this bank or this banking system, the result is the following. I'm just going to open up a spot here. I'm just going to calculate. Remember the calculations we did when we were calculating about the lost opportunity cost. If someone does this compared to that, what is the result? And I'm just going to make the total at year 10, how much went into this policy, okay? I'm going to do the same for year 20, which means from year 1, how much went into this policy from year 1 to year 20, and I'm going to do the same even up to year 30. And we'll see if they don't recapture all the opportunity costs they would have suffered if they would have financed things cash or lease or credit. Because either way, that interest will have to go. It will now be, is it going in their control or is it going into someone else's banking control? Now, I'm just going to pull out the where I had the calculations of the opportunity cost. Remember when we were calculating here, if someone was spending $20,000 every single year, I brought this number intentionally because I wanted to show you that 10 years in, 200,000 flowed through this person's hand. Let's say this is Lukas. 20,000 flowed through Lukas' hands. And the future value here is 251,558. And that's about 5% of compounding growth. It's like the total rate of return. And that's $51,000 that he forgo, that he will never earn. If the same thing happened in the policy, if he were to transit this same $20,000 every single year for the next 20 years, for the next 10 years, this is 200,000, and the cash value at this rate is 247,000. It's close enough. It's close enough because in this same year, $20,000 go in, the dividends will be 6,652. The death benefit is 1,167,000, and the growth inside of the policy is 32,219. That's the growth of the cash value from last year to this year. Are you confident that in 10 years, if you keep using your banks as a warehouse of your money, are you confident that whenever $20,000 passes, they will make available $32,000 in that same year? Are you that confident? I don't think so. The difference between $20,000 and $32,000 will go to the bank owners because they are the owners of the system, not you. Let's come back to year 20. Year 20, how much went through this policy? About 398,830. That is the maximum that could have gone in the policy, and that's exactly what went into the policy. And if it was this example of the opportunity cost, it's 400,000 that goes through the hands of this Lukas here, and the future value is 661. The interest that he would have lost is 261. But in the policy, somehow, it looks like he recaptured this. 398 went through, $672,126 is the cash value that is available, and the death benefit for the beneficiaries is 1.6 million. And in the same year, when $19,000 passes through this policy, 53,000 is the growth. And here's something here. Here's something that I want to attract your attention to here. So I will just ask this question. Do you think $20,000, do you think what $20,000 buys today is what $20,000 used to buy 20 years ago? No. Why? Inflation. These dollars, they lose value, they lose value every single day. What you can buy with these dollars today is not what you're gonna buy with these dollars tomorrow. So if you keep counting on accumulating these dollars in a place where you don't control, in a place where they never compound, in a place where they just keep flowing in, flowing out, you will suffer the consequences of inflation and the consequences of the loss of power of purchase of these dollars. Because in this example here, $19,883 will go through this policy in this year, and the growth in that same year is 53,000. How good are they doing with combating inflation? Are they better with this policy or better without? Did they miss any investment opportunity because of this policy? Do you think that they are afraid that their two young children might not go to post-secondary university with this policy? Not at all. By this time, they've achieved cash confidence. They have more than enough money to tackle most of the needs that someone needs to buy in their lives. Many financing needs can be financed in this family's life by the way of these cash values. And $672,000 20 years later, after they've transited $398,000 in the same policy, will never be small. If Lukas keeps living a long life, his family will just keep winning. And if he lives a short life and passes away, $1.6 million tax-free will do more good than harm. Now, let me finish with, at this stage of 30 years, where $597,661 passed through this policy. While $597,000 and 661 passed through this policy, the cash value is at 1.3 million. 1,379,583. This is real numbers. This is a contract. It will not suffer market volatility. It's a contract. And in this contract, only one party has the end of the stick of fulfilling the contractual guarantees. And that party is called the life insurance company. The only role Lukas and Emily has here is to pay premiums. Guess what? They were paying these same amounts into the conventional banking system. Here, By the time Lukas is 65, when $19,000 passes through this policy, the growth inside of the policy is $89,000 in that same year. Not 2 years, in that same year. The dividends alone can fully cover the premiums of that year. The death benefit, $2.5 million. His family will never forget what Lukas did for them. And if he keeps just on living, there goes the $1.7 million that I was telling them about. At the age of 69, where most people go touch their RRSPs, Lukas has $1.7 million of money that he can spend and that he will spend. And if let's say he has spent, the life expectancy today for men is around 80, 82, let me go to 82 years old, whenever Lukas will be 82 years young. So when Lukas will be 82 years young, how much money will have passed through this policy? Let's just do a quick calculus here. There you go. So for 47 years, $935,000 passed through this policy. The cash value is $3.8 million. The death benefit is $4.8 million. Now, let's consider that by the time he's 82, let's say that he has spent at least maybe 70% of these cash values. That translates to $2.6 million. How much did he put in this policy? $935,000. Whenever he puts $19,000 this year, how much grows in this policy? $197,000. Is he working too hard? No. Is he taking on more risks? No. Is he achieving the goal of becoming his own banker and never requiring a bank for anything other than the convenience of debit, and financing everything that his family will need in that time by controlling where money flows, and that money will flow back into this capital? Is he controlling that? Yes. Did he work too hard? No. Was there any risk or market volatility involved here? Absolutely not. Was he in control? Yes. So these questions are what is unseen. We can see the numbers, but we can't see the peace of mind that Lukas has. We can't see the quiet sleep, the quality of sleep that he's sleeping at night with an amount of money like as this one. So if he spent $2.6 million in this same period and passes away, his family will receive $4.8 million minus $2.6 million. That's $2.1 million. That's more money than Lukas has ever put in this policy. And that's only if he lives until the age of 82. Is he losing? Is he winning? He's winning according to me. And didn't he purchase all the cars he needed during his lifetime? Didn't he build a $1.7 million living asset he can spend while alive? Wasn't he in control? Did this take away any of the options on his table? Didn't he prepare for his children's education? And finally, who is the loser in this scenario? Not Lukas, not his family. He did all the work to achieve this, and he benefited from it while alive. And his family will keep benefiting even after he's gone. His family will never need the use of money from elsewhere if it's not from this policy. That's what infinite banking is all about. And that's the end of this masterclass. Hello, everyone. Thank you for following this far, this mastermind about the infinite banking concept. And if you like what you're hearing, and if you believe that this message resonates with you, I'm inviting you to go through the link in the description, and you'll find a place where you can take an appointment, and then we'll sit together. We'll sit and we'll see how this concept can be a reality in your life. We'll use your numbers, we'll use your reality, and then I believe that it can happen. My youngest client presently is 2 months old, and my oldest client is 74 years old. So anyone can implement this. All it takes is a desire. So if by this far you feel like this is you, I'm welcoming you to go through the link in the description and just take an appointment. And if it's difficult enough, you can see the phone number in the description and text me IBC. Text me the word IBC, and then I will send you, and then I will call you or contact you to take an appointment for us to go through a phase of implementation. Thank you so much, and I'm signing out.